So for more on that reaction to big bank earnings, at least early on this week here, let's bring in Gerard Cassidy of RBC Capital Markets. Gerard, is it all a story about, easy and hard comps all at the same time? Easy comps for things like the economic recovery, hard comps on things like trading revenues during the volatility last year. What exactly stood out to you?
You're right, Dom. When you look at the comps, depending on what type of business line, they are either easy or difficult. And if you compare the trading results to the first quarter levels of 21, those were difficult comps. Investment banking, as you guys have already talked about, especially on a year-over-year basis, those comps were quite strong. But what's interesting to us, and I think Karen summed it up well with Jamie Dimon's comments, he was quite optimistic about the outlook for the economy. And that tells us loan growth will start to materialize later this year and next year. In particular, if you look at JP Morgan's credit card receivables, this is the primary source of consumer borrowing. On an end of period basis, they were up 7%, 28% annualized. So we anticipate you're going to see more of that from the other companies like Bank of America, Wells Fargo, and Citi that report, as you know, in the next day or two.
Hey, Gerard, it's Tim. It's frustrating as a bank investor to see those reserves that rolled off, the $3 billion or so for JP Morgan, get shrugged off as if they're a non-event, don't really matter. And yet when they threw them on during record profitability a year ago, it was seen, wow, banks have a lot of credit exposure. Who knows what's going to happen? And they were punished for them. Is this will there be a delayed reaction for investors here? Because, again, this is profitability that was held back last year. I get it. But ultimately, it also sends a message that credit is much, much better for these guys.
You said it well. And in fact, you're so right. When they take the big hits like they did a year ago, it hurts the stocks, but they don't seem to get the benefit when they bring it back into revenues. Now, we all understand that it's one time in nature. But you said something very important. The credit quality is incredibly good. JP Morgan Chase had a 29 basis point charge-off ratio. I can't remember the last time it was that low. So it's not only the reserve releasing, but what it implies, which is credit is very strong, and that's very positive for all the banks, including JP Morgan, over the next 12 months.
Gerard, we've had this conversation before. I think pre-economic crisis, some of these banks, specifically like a JP Morgan, would trade close to 3 times tangible book. Here we are today, $69, 2.25 times tangible book. What's the right multiple for the premium brand JP Morgan in the environment that we find ourselves in right now?
It's really a good question because, as you know, JP Morgan does trade at a premium to the group. And the group, when you go back to the year-end 2017, which I would suggest was the first normal period post-financial crisis, because as you remember, the world changed following the financial crisis for all the banks due to the Dodd-Frank legislation. So when you go back to year-end 17, they traded on average at 2.2 times tangible, 1.6 times stated, which implies, because of JP Morgan's premium to the group, getting to a 3 times tangible is not that crazy. Now, granted, we need to see rates move. We need to see loan growth come back. We're not calling for that in the next 3 to 6 months. But if this economy comes back, rates come back, loan demand comes back, and we're sitting here at the end of 22, then those valuations are not that far-fetched.
Gerard, before we let you go, I always like to ask, is there a favorite part of that banking spectrum that you like? Money centers, investment banks, the regionals? What's standing out to you right now?
Right now, Don, I would say the universals or money centers, Bank Americas, the JP Morgans, et cetera, because they have the diversity of revenue. You get the strength of the investment banking business, but at the same time, you get the consumer strength that we foresee coming in the second half of the year. And then later this year and into next year, you get the commercial loan growth as the supply chain problems finally, work themselves out and the demand for loans starts to accelerate again.
All right, Gerard Cassidy, RBC, thank you very much. Have a nice day, sir.
You too.
All right, let's trade this guy. Let's trade this, guys, because I know the thesis for why you would want to get into the universals because of what Gerard Cassidy just said. Karen, is it still hold? Does it still hold? Can you still get in with these banks and feel like it's comfortable from a valuation perspective?
Yeah, I look at like a JP Morgan, and I think that banks always trade cheap to the market. They have a cheaper PE, they always have, but the amount of cheapness is now pretty high. So they normally trade tighter than they do to the market. So I'm comfortable owning JP Morgan is my biggest, but I have Citibank, Bank of America, and Wells Fargo, and Morgan Stanley, which is a little different animal.
Yeah, I am short of the XLF. I just don't find them to be that compelling here. I know Guy would make a valuation case for Citigroup, but you look at Citigroup and the way that stock has traded, it just hasn't seen an uptick in about a month or so, and it's probably the most off its highs of the major money centers. So I don't think you're going to see results out of Bank of America or Citigroup that get stimulate the group. They're not going to say anything more than JP Morgan and Goldman. I think JP Morgan and Goldman is about as good as it gets. We're going to see a good report out of Morgan Stanley, and then you start thinking about the back half of this year. And I'll just go back to what China did on Friday. What did they do? They cut the reserve requirements for their banks. They've already had their V-shaped recovery. So all this excitement about what might happen in late Q3 and Q4 in our economy, I think that it probably makes a little sense to take a step back here, especially with the stock market at all.
Can I just fight with Dan for 1 second?
Fight, please.
Okay. So let me ask you then, is there any price or any multiple, set of multiples, dividend yield, anything, at which you would buy Citi?
Well, I just don't know. I mean, let's look at the relative performance to Bank and JP, and obviously in Wells Fargo, I think that's a name that you're long. I mean, I suspect it's going to be worse than the other ones, and I think you just buy JP Morgan. You know, 150 in JP Morgan is a big level. It's a level it's held over the last, and forget about valuation. I'm just talking about from a trading perspective. Let's see if they can hold. It feels like it's going back there in the not so distant future, and they've just had these massive runs, this outperformance since November. But don't forget, people, before the vaccines, banks were making lows, right? Like they literally were making
everything was making
No,
lows.
they weren't, Karen. Back in October, I mean, just think of most of the market had come off of the lows. Banks were still going lower. So when you think about, oh, that's great, loan loss reserves, and Tim asked a great question of that analyst, but think about how many trillions of dollars of monetary and fiscal stimulus were thrown at this crisis to get us where we are. And we're talking about, oh, this is a good valuation for this bank or whatever.
We had the same conversation about Wells Fargo a year ago. It was down, down, down. Everything was wrong with it. You know, there were structural problems.
Well, I wasn't telling you to sell it there.
Okay.
Yeah, and if anything, in this fall, I got very constructive on the banks for the easiest reasons that their sentiment was so bad and the valuations were so cheap. So why wouldn't you buy them down there? But here, I don't find them that compelling.
I would just say that the bank trade has been this consensus value pick for a long time now, and it's only really started to kind of take off over the last 6 or 9 months or so. So if it has momentum, that's great.
Shepard Smith here. Thanks for watching CNBC on YouTube.